Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Chris Verrone. He's a partner at Strategas and head of their technical and macro research arm. Chris, how are you doing this morning?
I'm doing great, Ross. Thanks for having me.
Thrilled to chat with you. Really interesting moment in markets right now. I want to start with something you've been identifying, which is leadership from industrials. So big tech has been the story this quarter, but I do think that the leadership from industrials is instructive of what's going on in the broader economy. Could you break that down for me and maybe tell me what it implies about the broader market and economic picture to you?
Yeah, I think it's a great point. I mean, the strength from tech has clearly stolen a lot of the oxygen in the room this year, but I think a real credible alternative to just looking at tech is frankly the strength we've continued to see probably for 8, 9 months now from groups like industrials. And it's pretty broad within the sector. It's machinery, it's capital goods, it's building products. And I think recently, importantly, some of the transportation stocks have come in to the fold here as well. So, for those looking for what I would describe as credible alternatives to this impression that the market is only driven by tech, I would really point you in the direction of both industrials and consumer discretionary. Now, importantly, when we have seen industrial or even discretionary, particularly transportation leadership in the past, it's actually generally been associated with bond yields up, not bond yields down. And as you know, yields have been chopping for the better part of the last 8 or 9 months in a very narrow range. I do think we're going to get some resolution here on bond yields soon. And I think this pro-cyclical leadership tone coming from the equity market with stuff like the industrials and the transports working probably points to a greater likelihood of yields up, not yields down from here.
That's really interesting and comes at a time when the Fed is leaning more hawkish. The cyclical stuff is working a little bit better. So a key theme for the second half probably. So thinking about the broader market, you hit on big tech, you hit on industrials. What does the breadth picture look like at this point? There's this debate on whether it's a new bull market or not, and how important breadth is to answer that question. What are you seeing on that front?
I would call the picture under the surface as modestly broader over the last several weeks. It's still unusual in the sense that, we're almost 9 months off the October lows. October 12th was the low, so July 12th will be 9 months off those lows. You would expect the first year of a new bull market to be the rising tide phase of the advance, where everything works. It's incredibly broad. That's what we've seen historically. If you look at the major lows in the past, whether it's the 2020 low or the '09 low or the August '82 low or October '74, any of these really memorable dates in market history, the first year off those lows, it's incredibly broad. We haven't really met those thresholds this time around. So we're sitting here about 65% of issues above the 200-day moving average. Historically, you'd frankly want to see something like 80, 85, 90% of issues above the 200-day, kind of in that first year off a low. So I think it's a little bit better, but it's not quite of the same category as what we've seen coming off some major market bottoms historically.
That makes sense, and I think that squares with what people are feeling. But it is important to note that it's not just this narrow tech-led rally anymore, a bit broader under the surface.
Yeah, and Ross, it's not that narrow markets can't persist. It's not that narrow markets worry us. It's just unusual where in the cycle this market has been narrow, right? So if you're subscribing to the idea that this is early cycle, we're in a new cycle, it should be the broadest part of the market advance. Late cycle tends to be narrow. It can persist for a long period of time. Think, second half of '98 through early 2000, or think 2019 or 1973. Those are very narrow markets. They persisted for a very long period of time. So it's this tension. Are we early cycle or are we late cycle? I kind of subscribe to the idea that we're in some extended late cycle environment where there are some hints of cyclicality with the leadership from industrials and discretionary, but it's just not quite as broad as one would expect if we've turned the page on the prior cycle.
Makes sense to me. Let's end. We're kind of at a mid-year point in the market, ending June here. Pick anything that's important to you for the second half of the year, whether it's the dollar, rates, credit, something in commodities? What's a wild card for you that will be important for how markets perform in the back half of the year?
Oh, I think such an important question, and that the way you phrase that question, Ross, is such an important way to think about markets, right? There's the status quo, but you always have to be on guard for what would upset the status quo or what would encourage me to think about things a little bit differently. And I would just hit on what we mentioned earlier. I think it's about rates from here. Tens have largely been chopping, tens and 30s have largely been chopping for the better part of the last 8 or 9 months. It's about September, October in this 350 to 390 range. We're running out of real estate on those charts. I think we're going to get some resolution here very soon as to what the next major move there is. Anything above 390 is a very meaningful breakout on 10-year yields. Anything that's caught up below maybe 350 is a breakdown. I think how that chart resolves itself over the next month or two is going to have a really big impact on what the rest of the year looks like. What we've seen in areas of the world where rates have gone up recently. So think about, we had rate hikes again in Aussie, we had rate hikes again in Canada and the UK. The areas where you've seen the rate hikes, the financial stocks in those parts of the world have actually struggled. So I say that with some interest because when I see utility stocks very weak here, I see transport strong, and I see banks still struggling. That sounds like higher rates, not lower rates from here. So very important in terms of what we're on guard for in the second half of the year. I think the knock-on effect of that is also what happens with credit. I like to watch things like double B versus triple B to get an understanding of how the lower quality credits are being treated versus the higher quality credits. I also watch JNK, it's the high yield ETF. Those will be the important clues that we cue off of the remainder, 5-6 months of the year.
Great. Well, Chris, thank you so much for the time. I hope to talk again soon, and have a great one.
Thank you.